Hello, and welcome to Goodwood's Q2 Fixed Income webinar. My name is Sarah Van Aken, Vice President, Client Services with Goodwood Inc. Joining me is Chris Currie, the Portfolio Manager of the Goodwood Milford Fund LP and the Goodwood Milford Fund Trust. Today, we intend to share our view that strong economic data in Canada is a result of economic activity being pulled forward due to tariffs, and this is keeping the Bank of Canada on hold and masking a weak Canadian economy. We will address our view on the state of fixed income today, our interest rate forecast, positioning of our bond portfolios and Goodwood's fixed income products, before looking more specifically at tariff pull forward and economic data. It is my absolute pleasure to share a little bit about today's speaker, Chris Currie, Portfolio Manager of the Goodwood Milford Funds. Chris has an extensive background in corporate credit investing, having acted as a corporate bond portfolio manager at TAL Investment Council and as a sell-side research analyst in corporate and high-yield debt at CIBC World Markets, before founding Milford Capital Management and managing the Milford strategy for the past 18 years.
Great, Sarah. Thanks for that introduction. And my name is Chris Currie, as Sarah mentioned. I'm the portfolio manager at Goodwood Inc. in the fixed income department. And before we dive into the meat of the presentation, I'd just like to review quickly the key tenets of fixed income and what role it plays in portfolios. So fixed income really, still has a significant role, we believe, in portfolios. And that role is for diversification, for stable income, and for safety, for 100% return of capital. So in terms of the attributes of fixed income, the safe haven attribute, certainly there, 100%. You buy a bond, you get all your money back whenever the term of maturity is up. Stable income, same. It's a contractual guarantee to pay every 6 months. You get paid the stated rate of interest, and that is an event of default if that's not paid. 100% return of capital. Again, that's part of the reason that you want to buy fixed income, and that you're guaranteed that stability. So as bonds get closer and closer to the maturity date, the price converges around par because the certainty of receiving that 100% return of capital gets greater and greater. Now, the last one in the past 6 months or this year, we would have to say is a maybe. At the short end, certainly definitely true. But at the long end, we've seen some challenges as the US fiscal situation and the fiscal situation of Western economies has been challenged by excessive fiscal spending, which has put a lot of pressure on the long end. So usually when stock markets sell off, as they did in April after Liberation Day, you'd see a flight to quality, and especially at the long end. But we did not see that this time, and that really was because of these pressures from excessive borrowing on behalf of Western governments. So on the next page, we want to show you what happened in Q2 really. So no surprise, yields, you can see in the green line, yields are higher throughout the curve in Q2. March 30 is a yellow line. On the bottom are the spreads, the difference between the two. So really, in all segments of the curve, especially in the long end, yields widened, and that's due to a number of factors. I think that's because of the pressure that the pressure that Trump is putting on Chairman Powell at the Federal Reserve. Also, the inflation data is not really marching in a steady downward fashion towards 2%. In fact, there's been some months where it's actually ticked higher. And importantly, Chair Powell at the latest FOMC meeting stated that he expects meaningful inflation to arrive due to tariffs. So, these tariff inflation and concerns are really weighing on the bond market. But let's look at the year-to-date picture, which is on the next page, and that shows quite a different picture. So we've got, let's turn our eyes to where the two lines cross, which is about the 5-year term. So looking right of the 5-year term, we see that yields have risen. So yields up, prices down. So that's really the scenario that we described before in Q2. But interestingly enough, to the left of the curve, you can see that yields have actually fallen significantly. So that part of the curve, the 5-year and below to the left, is really where we position our portfolio. And so we benefited. So yields falling, prices up, returns up. So we benefit by constructing a portfolio that's primarily short-term investment grade corporate bonds, which are composed of what we feel are high coupons, high cash coupons as well. So on the next page, we're going to put all this into performance numbers. And you can see, looking at the Goodwood Milford Trust versus its comparisons in the next two lines below, we're quite happy with these returns. So the year-to-date number, quite significantly above both the benchmarks, the broad universe and the corporate benchmark. Same with the 1-year number, 3-year number, not so much on the corporate side, but again, in the 5-year number, back to that significant outperformance. So, we're quite happy with this performance, and we think that we'll cover that in the next couple of slides. So, next slide, please, if you don't mind. Yeah. So, what we're forecasting for rates going forward, we think that there's only going to be one cut, both from the U.S. and the Bank of Canada, and that's going to happen in Q4. In Canada, if you look at the very first column, the first two columns, you can see rates are very low in Canada. I mean, we've got rates of, the current policy rate is 2.75. So we can see it's, those are rates that are historically very low. Not a lot of room for the Bank of Canada to cut. U.S. has more room to cut, and that's where President Trump is putting all his pressure on Chairman Powell, saying that rates should be cut 100, 200 basis points. Sure, they have lots of room to cut, but they're also dealing with inflation, and they're also dealing with a huge fiscal stimulus package that's coming down from the big beautiful bill, which was just recently passed. So on the next page, I want to get a little bit into where we think, given that, where we think we're positioning our portfolio, where you should position your portfolio. So we're still firm believers in investment grade corporate bonds. So we think that you can pick up 100 to 200 basis points. That puts you at coupons that we're buying in the new issue market in the mid 4% range, which we're very happy with. So that's a real rate of return of 250 basis point, which is attractive. We think that there won't be a technical recession in Canada because the fall budget is going to provide a lot of fiscal stimulus, and that's going to keep that spending will keep Canada out of a recession. We think that the uptick in economic growth in the U.S. is also dragging Canada along to some extent. That we're seeing that in the numbers, and given the slope of the yield curve, really to get high coupon, we're favoring 3 to 7 year terms. And so let's look at the next slide, where we look at what we think is an interesting cross section of the investment grade, the corporate bond market. So what we call core income, in bold, are the bonds that are in the Goodwood Milford Trust right now. So you buy the trust, and these bonds are there, and these are what we would call jokingly solid gold. So if you look at the coupons, I think you'll agree, 2 at 7%, 1 at 5 and an 8. So very attractive cash payments. So those are very attractive cash coupons. The fund does pay a 4% annual distribution quarterly, so that's 1% per quarter. And I wish all our coupons were at 7%, because we would handily cover that distribution. But as we see in a little bit, that distribution is well covered by other bonds as well. So we talked about the sweet spot of investment grade investing. So that's what we see as the 5 to 7 year area. So there's some samples of bonds we've recently bought. in the high 4s and 5%, all, household names, maybe Pembina not so much, but Hyundai Canada, Saputo, very strong companies, investment grade, and very attractive coupons for that 5 to 7 year term. Just as a, sort of somewhat of a humorous note, we call this section only for the brave. So, if you really want to get yield, you can go into the high yield market and buy Obsidian Energy, which is paying almost 12%. We don't own that one, but we do own the one below, SNC, and that's paying 7%. That's up, that matures in about a year. So the company's it really improved its fortune. So we think, there's a really strong name there and really high coupon. And if you really wanted to take a capital gains play, you could buy Province of Ontario, 1.9% of December 51, trades 60 cents on the dollar. In 25 years, you're going to get 100 cents on the dollar, but that's 25 years may be too long for some people. So, but that bond's going to really swing around with market interest rates. So looking at the next page, where we set out our current bond holdings, and down at the bottom are the highest cash coupon yields. So, I like to focus your attention at the ones to the right of the 5% mark. And I think it's safe to say that that's, over a third of the portfolio. And, some very strong investment grade bonds and, very strong coupons. So the majority of the portfolio, over 4%, you can look at the names on the left-hand side. I'm not going to go through each of them, but I think we've constructed a very high cash paying portfolio that's, it's a shorter duration and, it's well protected. So the next slide is really the key to our portfolio construction, which is diversification. So we're well diversified on a number of metrics. The first one being position size. So none of the positions are over 4%. And we're also well diversified by the type of security, whether it's a federal treasury bond, a provincial bond, or investment grade corporate. We're diversified by credit rating. We have, the full spectrum of investment grade from AAA to BBB. The term to maturity is also an important diversifier because depending on the term to maturity, that determines the volatility of the bond. Obviously, very long maturity bonds are a lot more volatile than, extremely short bonds. But you can see we've broken down the range of maturities that are in the portfolio, and you can see the vast majority is in the very short area. Lastly, coupon income. We have, I correct myself, we have over 40% of coupons over 5%, so very high cash generation there. And almost the remainder of the portfolio is between 4 and 5%. So we're very active managers, bottom up fundamental analysis. We're not tracking the index. We're really actively managing to provide total return and income generation. So on the next page, I believe I'm turning it back to Sarah.
Okay. Thanks, Chris. So while I think a case can certainly be made that traditional bond funds and ETFs also offer diversification by benchmarking to a broader market index, the Goodwood Milford strategy's more flexible mandate allows the fund to be proactive and opportunistic in changing market conditions, with the ability to profit from an increase or decrease in interest rates. So the long-short credit-focused portfolio is opportunistically invested across credit ratings, maturities, and can benefit from the use of leverage and equity exposure to generate returns independent from the broader market. I'll ask Chris to help us better understand how tariff pull forward is relevant in this context.
Thanks, Sarah. So we wanted to have a look at some of the recent economic data in Canada and highlight what we're seeing. And we've noticed some interesting phenomena, and a lot of it's focused on the balance of trade, which is on the next page. So what we have is here is the overall balance of trade for the Canadian economy, and you can see a big swing up in December and January, where we think companies were what's called front running the tariffs as they increase their economic activity to get ahead of any potential tariffs. And you can see that the balance of trade has dramatically fallen after that. And then when we dig into the details on the next page, it's really clear the import volumes in the Canadian economy. Again, big swing up into January, February. People importing raw materials and products to finish their manufacturing cycles and stock their shelves. The next page, even more dramatic, is the export picture, where pretty safe to say after that upswing, there's been a dramatic drop. And so we think that these numbers are going to be reflected in Canada's GDP, which unfortunately, is really, well, it's reported monthly, but the numbers come out, not in I would say not in an extremely timely fashion. So you can see that the bulk of the monthly numbers here are hovering around the zero mark, and we would expect those numbers, as a result of tariffs, are going to drop off. The next page, the weakness in the Canadian economy, in industrial production, again, dramatic decline after an upswing in January, February, or December, January this year. Following page, this, business confidence reflected that downturn. We think the recent upturn is probably related to a stronger U.S. economy, and perhaps that's providing some optimism that things are not as dire as people had expected. But as we get into the consumer sector, which is, as we know, 75.75% of the economy, consumer confidence is falling off. And the next page is an interesting chart that we found online from the Altus Group, which is a big real estate database company, and they do a number of things. So they provided this chart on their website, and it shows for Toronto only. It shows housing starts on the left-hand side and their forecast of future housing starts, and then housing completions in the middle. And what we found most interesting was, you sum those two up, and you derive a construction investment graphic, which is on the far right-hand side. And you can see from the peak in 2024, it's almost $6.7 billion. According to the Altus forecast, if their numbers of housing starts and completions come to bear, that amount of construction investment is going to fall to 1.9%. So that's, that dramatic drop off in investment and its impact on jobs, on companies in the business, is really driving our view that the fall budget is going to be very stimulative to the Canadian economy. And, you can just see the numbers there on the screen. So lastly, I want to, the really, the poster child for the Canadian economy is the unemployment rate, which has been just on a steady climb upwards. I mean, if you saw these numbers in the US where they're tracking around 4%, if you saw a 7% number in the US, they'd be screaming recession from the rooftops. But, that's a situation in Canada. It just continues to go up. And, certainly, we think that that's going to be addressed. So is there one more slide, sir, or is that it? We got, the last slide, retail sales ex auto, again, similar picture to what we saw before. Big upswing to front run the tariffs, and then, a downturn in sales subsequent to that. On that note, I think I turn it back to you, Sarah.
Thank you. So offering ongoing fixed income insights, our team prepares monthly Goodwood Milford commentaries, quarterly fixed income presentations, webinars, and updates following each Bank of Canada and FOMC meeting. If you're interested in being added to our distribution list, please contact us, or you can check out our most recent materials available on our website at goodwoodfunds.com. On behalf of the Goodwood team, I'd like to thank you for your time and extend an invite to schedule a call or meeting directly with us to discuss the Milford strategy or how you may invest in the Milford Funds. Thank you.